morning friends, welcome all to the IBS digital platform. So today we are going to discuss a topic with regard to Jaiib. The topic I have selected for you is bank reconciliation statement. It's the most important statement which in everyday life any businessman or even an individual, he has to prepare this statement so that he can reconcile his transactions with the bank on an ongoing basis. So we will see what are the basic aspects which you have to look into in this particular reconciliation statement. Just go through this. Preparation of bank reconciliation statement is of very great importance to a customer or trader. Usually the bank balances shown by the cash book does not agree with the balance as per passbook due to various reasons. The trader has to identify the reasons for the difference. This is possible only by preparing a bank reconciliation statement. Thus, BRS facilitates the reconciliation between the two books, namely cash book and passbook. Hence, this is not a rectification statement but a reconciliation statement. That is what I want to highlight to you in this particular topic. It is not a rectification statement, mind it. It is only a reconciliation statement. How this is going to be effective, just see this. Most of the cases we are facing with different problems whenever certain transactions are taken place in our business unit with regard to banking transactions. Normally some differences we may see in those transactions. What are the differences normally that will come across in a banking scenario? I have listed something, you can go through it. The first one is check issued but not presented for payment. Suppose a customer is issuing a check, what he usually do? He will actually make a payment or register a payment in his cash book. That means he is reducing his deposit amount because he is issuing a check. That check is normally presented to the bank, same bank, Jaiib bank, only after some period of time. So there is a gap. In between that, there is mismatch of balances of cash with the bank as well as cash in our book. So this is one of the reasons why bank reconciliation statement is essential. Next one is check paid in for collection but not collected. Whenever a check is paid into the bank, that is, the trader is submitting the check for collection. He is preparing a paying slip and he is submitting the paying slip along with the check to the bank for collection. Normally after collection, usually the bank will credit the bank account of the particular customer, but that will take some time. So whenever the businessman is delivering the check for collection in the bank counter, normally what he will do? He will immediately increase the bank balance in his cash book. So now the cash book balance has increased, whereas the passbook balance is not increased simultaneously. That is another reason. Then comes direct payment by a customer to the bank. Suppose our customer, the businessman's customer, is remitting cash directly to the bank account of the particular customer. Definitely the bank account shows a higher balance, but since there is no notice of this, or since the businessman is not aware of this fact, his cash book balance will show a lower balance. So the cash book balance is now lower than the passbook deposit balance. Another reason. Next one is actually interest on deposits credited by the banker. Mostly the banker will credit interest in our account normally by the end of a month or any other date which is stipulated by Reserve Bank of India, or which is as a matter of fact the board of directors of the bank will consider it fit. So that time automatically the bank deposit account will increase to the extent of the interest credited into the account. But since there is no notice of this to the customer, so the same day customer's cash book balance shows a reduced balance. There is a difference. Then comes bank charges as per passbook. When our bank is charging some amount by way of charges to our passbook, normally the deposit balance will come down. So balance as per passbook deposit balance has come down when you compare with the cash book balance. So cash book deposit balance is now higher than passbook balance. This is another cause of difference. Next, suppose if you are preparing a bank reconciliation statement and if you start with that deposit balance, then certain adjustments you have to make in order to arrive at the bank balance as per passbook. If you are starting with an overdraft, then definitely on the reverse process you have to adjust the things. That means if you start with a deposit balance, normally certain transactions between bank and the customer will be added and certain transactions are deducted to reconcile the entries. On the reverse, if you start with an overdraft balance, whatever items you have added earlier when you have started with a deposit balance, those things should be deducted here, and whatever amount you have adjusted by way of deduction in the earlier case, that is when you start with a deposit balance, here you have to add those things. We will see certain examples. See, one example I have cited here. You can go through this in the board. On 28th of February 2002, cash book of Benny showed a debit balance of rupees 3,500. On checking his cash book with passbook, the following items of differences were traced. Checks issued but not presented for payment, rupees 900. Interest on investments collected by the bank, 700. Bank charges seen only in passbook, 70. Direct payment by a customer to the bank, rupees 300. Checks deposited for collection but not collected, 1,800. Just you watch how a bank reconciliation statement was prepared based on this information. Here we have started the reconciliation with the bank passbook deposit balance 3,500. The first item is checks issued but not presented for payment. When a check is issued by the customer, immediately what he will do? He will reduce his bank balance in his cash book. So his cash book is reduced to the extent of whatever amount, 900. So cash book deposit balance is now 900 less than passbook. So passbook is on the higher side. In order to arrive at the passbook, you have to add that entry. The second one, interest on investments collected by the bank. The bank has collected certain interest on investments which the customer has entrusted with the bank. So normally the balance as per passbook has increased to the extent of interest collected by the bank. You have balance as per cash book where the deposit balance is now lesser than passbook deposit balance. In order to arrive at the higher passbook deposit balance, you have to add here. Third one is direct deposit made by the customer. Similarly, whenever a customer is remitting cash directly into the bank account, normally the bank account deposit balance will increase. So passbook balance is now on the higher side, cash book is on the lower side. You have to arrive from the lower cash book to higher passbook. You have to add that entry 300. So the total three items you have to add, that is 1,900 is the total. And along with that, you have to deduct certain transactions. First one is bank charges debited only in passbook. Bank has debited certain amount in the passbook. So definitely the passbook balance, deposit balance has come down to that extent. You have the balance as per cash book. Cash book balance is now higher than the passbook. You have to arrive at the higher passbook, lower passbook from the higher cash book. You have to deduct that entry. And last, checks paid in but not collected by the bank, 1,800. Checks have been paid in by the customer. Whenever the customer is tendering a check for collection with the bank after filling the pay-in slip, normally the bank will collect it on a later date, is it not? In that sense, suppose if the customer is delivering this check for collection to the bank, immediately what he will do? He will immediately increase his balance as per cash book. Bank balance as per cash book has increased to that extent. Whereas actual clearing operation is taking place on a later date. That means the passbook balance is not increased to that extent of cash book balance. You have to arrive at the passbook which is lower than the cash book. Definitely you have to minus it. This way you can prepare this statement which is most useful in everyday banking and business life. Thank you very much.
If you like our content, do like, share and subscribe.